Hello, my name is Matthew Manson. I'm the President and CEO of Radisson Mining Resources with the O'Brien Gold Project in Quebec.
Hi, I'm Kiran Patankar. I'm a President, CEO, and a Director of Maple Gold Mines. Maple Gold Mines is an advanced exploration and development company focused on our 100% owned Douay and Joutel gold projects in the heart of the Abitibi.
Gentlemen, good to have you here. We're going to have a little sort of chat about the Abitibi and indeed the next chapter of the Abitibi story. So, I mean, Matt, just give us a little bit more background on what you're hoping to do there in one of the world's richest gold belts.
Yeah, the O'Brien Gold Project is a former producing mine, one of the richest gold mines historically, and it's surrounded by other people's mines and mills. It's right off the highway, equidistant between Rwanda in the west and Val-d'Or in the east. There's currently about 1.5 million ounces of high-grade resources, new resources adjacent to the old mine. The company's involved in a very aggressive step-out drill program, the biggest drill program in the company's history, 140,000 meters, and that's all about growing the size of the resource. And we ultimately see here the path for this project to follow the heritage of this type of mining in the Abitibi, where this project will most likely become integrated into one of the many mill and mining complexes around us.
But Matt, tell me this. I mean, this is a kind of high-grade mine revival story. Are there many of those operating in the district?
I think you know, when you look at the map of current and former mines in this part of the Abitibi, you know, there's a lot of former, you know, there's a lot of maps and points on the map, right? The type of deposit we have, which was high-grade quartz sulfide veins within what's called the Piché formation, adjacent to what's called the Cadillac-Larder Lake break. That particular package of things has been quite common, and there are other deposits like that adjacent to us. The most recent example was the Lapa deposit, which was the exact analog for what we are, which was developed and operated by Nico Eco for a number of years up until 2018. So I think one of the features in the Abitibi is that there are a lot of historical deposits. There are a lot of historical deposits getting new eyes and new work and new drilling. And there are also new discoveries being made at the same time. It's a very, very richly endowed part of the world for gold and precious metals mineralization. And in our particular case, the former mine ended at a kilometer depth, and it ended for economic reasons, not for geological reasons. Gold was $35 an ounce in 1957 when the mining stopped, and they weren't going to go any deeper than a kilometer. You know, what we've said is that 2 kilometers probably now is our economic floor for our exploration. That's our horizon for exploration. Again, it's not a geological floor, it's an economic floor. And so we are, you know, using that perspective to our exploration, and we're going down and we're having success below the old mine and below the current mineral resource. So not an uncommon story. I mean, I think this isn't kind of rocket science very much when you're exploring this type of deposit in this part of the world. You know, it's a very, very richly endowed part of the world.
So, I mean, Kiran, you've got something similar going on there, you know, in the district. But as Matt said, there's a lot of opportunity in the district. Do you need to stand out, or do you just need to execute?
Yeah, well, I mean, we've done both, right? And I agree with all the comments on the endowment of the Abitibi. You know, you've heard it time and time again that you know, geology doesn't change, but, you know, teams change, and management teams, you know, can either execute or they can't. And the things that you can control, one of the things we've done at Maple over the 2 years that I've been running the company, I mean, we've got, you know, our cost structure in a place where it's sustainable. You know, we've got both on a corporate level and from a drilling standpoint, cost per meter. We've rethought the geology of a well-endowed system. I mean, for those that aren't familiar with Maple, we're just north of Matt's project. So also similarly endowed with infrastructure. We're road accessible, highway goes right through our property, grid power, you know, 4 cents per kilowatt hour. But the thing that's interesting about where we are is we straddle a different break in the Abitibi. We're on the Casa Berardi break, which is probably less explored. Matt's right on that main corridor, you know, the highway head frames, which is amazing. You know, the Cadillac-Larder Lake has been well explored, although there are lots of opportunities there, as Matt alluded to. The Casa Berardi, I mean, Maple's the largest landowner on the Casa Berardi trend. To the west of us is Hecla's producing Casa Berardi mine. To the east of us is a former producing mine called Veza. And on our property, we actually have Agnico Eagle's first producing gold mine. The namesake mine of Agnico Eagle, the Eagle Mine, which was part of the Joutel mining complex, which produced 1 million ounces at 6.5 grams between 1974 and 1993. So, yeah, do you need to stand out? I mean, I think one of the things that we stand out with is there are only 7-ish companies in Canada that have 3 million ounce plus gold projects that are, that actually have existing infrastructure in place that don't need, lots of government investment in new roads and other things. So, yeah, I think that makes us stand out. We're one of the cheaper ones, although we're clawing back value rapidly with consistent execution. And personally, I think that the majors, while they are looking for, to continue finding high margin ounces, I think Agnico's been one of the best performing companies because of their production base in the Abitibi. And we know while the gold price has been up, the Canadian dollar has been getting pummeled. So in Canadian dollar terms, the gold price is way up, and finding additional ounces in a jurisdiction like the Abitibi, and in particularly in Quebec, is very much of interest to the majors. We're blessed with a almost 500 square kilometer land package, 3 million ounces plus and growing, a past producing mine complex, and lots of exploration potential. So I think we stand out very well there.
Okay. So, Matt, I don't know how you respond to that, or how you build on that, quite frankly. But you've got a very sort of systematic approach to discovery, in terms of deep proof of concept step outs, etc. But do you think that's what it takes? Or again, how do you measure your own success in terms of executing your plan and your exploration philosophy?
I think in the past, one of the sins that's been committed in weaker markets, admittedly, is the companies will raise a little money and say something's going to happen, and then they bump along and not much happens, right? So I think in this current market, people with good assets have the ability to raise quality money, have good treasuries, and actually execute, right, and do things. So we've said we're going to do a certain number of meters, and we've actually even said what we think the target is going to be in terms of a future potential resource, and we've kind of put that out there as an exploration target with ranges of grades and tons and a range of ounces. But and that we've put out the thesis by which we are pursuing that target, and then we're telling people on a regular basis how that's going, right? So that's what execution means for us. And I think companies with good assets now have the opportunity to do that and to follow that, right? I think that's actually the measuring stick that should be used in this particular market now. For companies like Maple and Radisson, right? Companies that have good assets in good jurisdictions that are properly funded with experienced teams, and now it's time to execute.
Yeah, I think, Matt, that's a great point. And we're blessed because we share a common strategic shareholder in Michael Gentili. And admittedly, Michael, I know, has been a part of the Radisson story for a number of years and has recently become, a cornerstone investor of Maples and, strategic advisor of Maples. But I think what he saw, and he's recently spoken about this, is what he saw in Maple was the focus on execution, right? I mean, you mentioned it as well, is what we've done, similar to what you guys have done. I think both Maple and Radisson have a similar approach. Is we've told people we're not out here to put press releases out to move a market, right? I don't control the market. I control what's happening on the ground, what's happening in terms of furthering our understanding of a potential world-class Tier 1 deposit with lots of exploration upside, bringing the right people into the story, both from a operational, managerial, technical, and from the new shareholders that we brought into the company that are sort of long-term focused, right? So that we don't have to, just focus on putting out, news for the sake of driving share price, in the short term. We're really looking at, and again, I think both of us have that same view of, at least Matt, I'd love to hear more about your background. I know I come from more of an institutional, investment banking, large cap, that type of market. And to me, while the retail aspect is very important as you're running a junior company, I think one of the things that I think we probably both agree on is that, having these long-term supportive strategic shareholders who understand the dynamic of what's going on in the Abitibi, it's critical.
I mean, what's Matt bringing to the table for you? Sorry, what's Michael bringing to the table for you, Matt?
Well, Michael is a sophisticated investor, and he's a very hands-on guy, right? So he's on our board, and he's a significant investor as well, shareholder, and he is he is bringing a very constructive capital markets and sort of strategic perspective. And what I mean by constructive is that lots of junior resource company, every resource company has somebody on their board who puts their hand up and checks the box on their filings every year to have expertise in capital markets. I'm the capital markets guy, right? And so every board has one or two of those people, and sometimes their expertise isn't perhaps as frankly as good as it could be. Michael's the real deal, right? Michael is in the market. He's investing in companies. He's investing in companies after diligence and thoughtfulness, and he's got an investment philosophy, and he kind of executes upon his own investment philosophy. And when he's at the board table, he is terrifically value add, right? I mean, I've had a fantastic. I knew Michael before Radisson because he was an investor in the company I was previously running, and I do have a bit of a different background from Kiran. I've come from a kind of a project development background, so I'm a geologist professionally, but I found myself working in single asset companies that have projects to develop, and I was a lieutenant in Aber when we were the joint venture partners at Rio Tinto building the Diavik diamond mine, and I went through a project construction process as the technical guy for the JV partner with Rio Tinto. That was one thing, and then I was CEO of a company that built the last major mine to be built in Quebec, actually, which was the Renard diamond mine, and that was, both of those projects were in the diamond business, which is another story in and of itself. And then Marathon Gold building the Valentine Gold project. So I'm the guy that you hire when there's a mine there and it needs to be shepherded through the process of, down the conveyor belt of permitting and team development and iterative mining studies, environmental assessments and social acceptability, everything you do to have a success. So I've had 3 projects now behind me. And I think, I find in Michael, my skill sets, Michael's skill sets, the board that we've put together at Radisson is a fantastic mix. So I can't say enough about Michael Gentili, actually. And I had the sort of experience of traveling with him for a week, 2 weeks ago, through Europe, 5 cities in 5 days, with a number of other investments of his, and talking to investors in Europe. And every lunch, he would start with a presentation of his investment thesis, and then the 6 companies on that trip would get up and illustrate that with our stories. So I think Michael's becoming an important person in the mining business, I think, more so, every year, and it's clear why, I think.
Yeah, no, I was lucky enough to sit in the sort of the London presentation where he talks about the investment thesis. So he's definitely a man with a plan. And I think the other thing is, it struck me it's his money. It's not a sort of casual approach to allocating someone else's money. This is his money. He really deeply cares and does the work. I mean, I guess, Kiran, to that point, you both got something in common there, not just the investor, but the thesis that Michael Gentili has. You both tick the boxes. So you've kind of got this kind of focus on a large-scale multi-style mineralization system. You may qualify it differently, but and obviously Matt's got his own sort of goals. So what was it you think that sold Michael on what you're doing?
Listen, I think like Matt. I've known Michael for years, and I've been with Maple, as you know, since 2021, right? And I've been gone from corporate development to CFO to, I was one of the principal liaisons with Agnico. And so while I do have an investment banking, 8-year+ investment banking background and lots of transactions and deal flow under my belt, so I am the person that does tick the box on my board on the capital market side. I'm also a geological engineer by training, right? So, I spent a lot of the time on the ground. Agnico asked me to step in and be the general manager of the Agnico Maple joint venture when things weren't going the way we had all hoped they would. And, to be able to turn around both a company and a project, right? These are different skill sets. I think what I've known, what Matt also alluded to in the beginning about execution, we've demonstrated that, we've shown that consistently to Michael. And I think you've spoken to Michael in the past. So for example, when I restructured our joint venture with Agnico, which I think was it came from the right perspective that, in a rising market, 50-50 JVs or JVs generally are looked down upon because they work in lesser, when you're capital constrained, it's nice to have a deep-pocketed partner, footing the bill for exploration. In a rising market where capital is starting to become available, you still need to maintain the same level of discipline. But, we were able to, in 2024, take with good both investment banking and sort of understanding of how the market, would view our projects and all the aspects. Like, we knew Agnico was a supportive partner. We just knew we needed a better structure to drive the company forward. I told Michael what I was going to do. I ran into him. We were having some discussions on some other things. I think he was also saying, you're going to get Agnico to invest at a premium? Yeah, good luck with that. And we did it. And went out and subsequently raised quite a bit of capital, went out and executed a drill program on time, under budget, with some meaningful step outs. And, you said it in terms of what we're trying to do. Yes, we have a massive land package and massive land position, but we have a focus both on the exploration upside and exploration potential, but also growing. So while we're adding, trying to add ounces that are sort of higher quality ounces and grow that deposit from 3 to 5 million, it puts us in even rarer territory, particularly with all the infrastructure and other advantages we have. We have development opportunities as well, right? So I think that was when you look at, for example, Michael's recent investment in Maple was done at 60 cents. I also not just brought in Michael, I turned over my board. I brought, a 34-year veteran of Agnico Eagle on the board, as well as Chris Adams, who I worked with for many years at Macquarie, who's got an extensive project finance background in the Americas. And so Mike came on, we had new investors come in, and then, immediately after that, the stock, it performed. People started to recognize what we've done. We've subsequently gone out and raised $13 million at 100% premium, and Michael sees this as all, incredibly supportive. And again, we're just getting started because we've just completed our investment and deal with Mike. But look, I think, Radisson has done an excellent job, but we just saw a deal announced this morning with another company that Michael's involved with at Northern Superior. So having him is a tremendous benefit, I think, to all of our companies, and we're delighted to have him on board.
For sure. I mean, just on the money side of things, obviously, Radisson, I think it's around 25 million for Radisson, 13 million for yourself. But we're coming off the back of a series of years where that kind of that technical de-risking in exploration has been undervalued. So how you go about allocating your capital in a market like today, which is seemingly getting a little bit easier, well, hopefully a little bit more forgiving than past years. Where do you throw your money, Matt? For instance, you raised that money for a specific reason, and do you think you're going to get a return on it?
Oh yeah, I mean, almost all of that money is going into the ground and drilling. This 140,000 meter drill program, and I think our discovery costs have been like, $30-40 dollars an ounce, and our valuation line is probably $150 an ounce. And whilst we can talk about the trend of the valuation metrics for companies like ours, that's an accretive exercise every day of the week. And so, if we feel we can find those ounces with that money, and so it's kind of a no-brainer for us to do that. One of the things that with it in the allocation of capital, I mean, I'm working from home here, right? And we don't have a corporate office in downtown Toronto. Our office is actually at the project site, not even around Aranda. It's actually at the project site, and so we have no plans to change that. This works really well, right? So. Our money is really, I mean, one of the lessons that companies like ours learn in the lean years is how to sort of do things on smaller budgets, and sacrifices are made along in that process, but there's no real reason to go backwards. When you've raised larger amounts of money, and you're now executing on your business plan. So it's very efficient use of deployment of capital, right? Very efficient. And we're also working with a drill contract that was set up a couple of years ago. and we've managed to maintain our pricing in terms of prices per meter with our drill contractor, who's David Bradley of the Bradley brothers family, who had a successful drilling business, sold that business to Major, and a few years later now we're working with RGLL, David's new company, and he's happy to grow with us as we're growing. So this has all worked out really well, we actually took the position, we'd raised a couple of tranches of financings last year, successively bigger ones. I've done 3 now since I came in about 15 months ago. The previous 2 were non-brokered with Michael's involvement, very hands-on. Michael brings a network of sophisticated high net worth people, and we built non-brokered financings around that group. And that had the benefit of knowing where we were putting the money and who our shareholders were. This time, this particular market, all institutional, sell-side dealer, bought deal, 22 institutions in the book, no flow through in there, no warrants on there, nice tight discount to market, really quality financing. So we're in a nice moment here where you can raise quality financings, meaning really long, sticky precious metals funds that want to go with you in the journey that you're telling them you want to go on, lucky here to have a good project and ounces to be discovered, in the deployment of that money, right? So
yep. One thing that I thought was interesting about what you said, Matt, was exactly that sticky shareholder, that institutional money. I mean, we've seen, in where we are in the cycle, like there are some things in the market that just never change, right? That these are commodity cycles, and we've had several years of junior companies in particular being starved for capital, and so you're going to advance your project in a certain way when you're kind of looking over your shoulder as to when your next raise is going to come from, right? And so taking the moonshot type exploration, the thing that the industry needs as a whole is it needs to discover new ounces, right? And new quality ounces. But the capital to fund those discoveries has been, it's been slim up until just recently. And I think that represents, in the case of our financing, similar to Matt's, it kind of came out around the same time. So it's amazing to look at the similarities between the two. I was approached at a recent conference by a large U.S. fund manager with a multi-billion-dollar U.S. mutual fund, pension fund, who I've been speaking to for the better part of the year, and would have been an investor in our story a year ago were it not for the fact that we were a 30 billion market cap company, and the size of the checks that fund wants to write are significantly, would have put them over a certain ownership threshold in the company. So, when we did execute, we brought Mike on, we got our re-rate, initial re-rate. This fund manager approached me on the stairs at Beaver Creek and said, hey, I've seen what you've done. Again, execution, right? Tick the box. We need to have a sit down. And I walked him through the technical. Again, same thing I did with Michael, which was, some of the things that people needed to understand was, what is our technical approach going to be? And this investor came to me and they said, okay, you're funded for a 10,000 meter program with this $5 million you just raised. You're funded for 10,000 meters. But he said, it seems to me that doesn't even begin to scratch the surface of the potential. And I think you know where you need to go. What would you do if money weren't an object, right? I like that question because similar to Matt, I have the discipline of, having, 4-star G&A down from, $6 million a year under a predecessor CEO to $2 million a year, right? $175,000 a month. I wear multiple hats. My VP Tech Services is both a VPX and managing the studies. We don't have, lots of people in, all these different functions. We have a very small C-suite, and we're basically running at the minimum of a listed, cost of a listed public company in Canada while we're deploying more of that capital in the ground, right? I'm a significant shareholder of this company. We've now brought in this institution, basically came in and they've taken we're closing our financing on Thursday, but they're taking a 10% stake in the company and, doing so with a $7 million lead order. The rest of the book sort of filled itself and we had, an oversubscribed financing. We could have taken more, just as we could have taken more money on the $5 million round that Mike Gentile came in on. We turned actually money away because we want the right kinds of investors in the book. We want the ones that aren't, the hedge funds that sort of trade your stock back and forth and knock you down. We also did, like Matt, we did a financing at 6 cents with Mike with a full warrant because I got the entire non-Agnico side of the deal. Agnico also participated in that raise. Every new investor that came in under that deal, I got to sign on to a 12-month lockup, right? Clear long-term focus, long-term alignment of where we wanted to go. The next financing we did was at $1.20, so 100% premium with no warrant. And all institutional, right? And it sets us up for, as I said in my first early part of this comment, was we can think strategically just as Matt. I mean, Matt's doing an amazing, 140,000 meters is awesome. And I like Matt because I've visited the project site at Radisson. I've been to the core shack. We're neighbors, right? So Maple is very similar. I mean, you're seeing a Vancouver to downtown skyline behind me, but this floor that we're on here, I mean, at one point, somebody had picked up the whole floor at $20,000 a month in rent. One of the first things I did was I subleased that corner, this corner, and that corner, kept this office and a few others, and we're down to $4,000 a month, right? So, and our office is not at site. It's not in downtown Rouen or downtown Val-d'Or. We have a camp, a full-service camp that allows us to really, while it costs money, to maintain that camp when you're not drilling, it is a very comfortable place to be. If you're planning to build, grow ounces, discover and advance the next major gold camp in the Abitibi, certainly we've got people that are trying to operate, put a mill into production just south of us, and they're coming to us because they actually want to rent our camp, right? The camp itself is a strategic asset, right? Because there isn't a lot. There's a lot going on in the area, between Amos and Matagami. But there's not a lot in the way of companies that are set up well to do the kinds of exploration and development that we'd like to do. So,
well, and I want to talk about infrastructure and strategic partnerships in a second, but I just want to get this one question out of the way in terms of attitude to how you build a company and how you build value in that company. So, Matt, on you, high grade versus large scale optionality. We've seen a whole bunch of companies come through the platform in the last 12 months talking about a nearer term revenue story, especially some of the high grade guys like the newfound Amexes of this world saying, look, we can drill this thing out till, to our heart's content, but at some point we need to kind of get market recognition for what we've got. We're going to go small, early with our high grade. What's your attitude to that kind of strategy? Is it something that you've thought about? Is it something that you think you may employ?
I'm a bit of a contrarian, to be honest. So I don't want to, there is always the temptation when you have a high grade deposit in particular to think about a bootstrapping type development strategy. We know what we're doing. We're going to sort of get this thing started. We'll start small. We'll make money, and the money we make will finance the next stage. And then, there's phase 1, phase 2, phase 3, and then it's going to be really, really, cheap to start this process, and we'll have success, and it will finance itself internally, right? So, bigger companies don't do that, right? Because they have balance sheet flexibility to not do that, right? Big companies say, okay, well, what is the size of this deposit? How best should we mine this? That dictates the size of the mill. Well, let's do that, right? We'll mine the high grade first and the low grade second, and then, then we'll see how long the thing goes, right? I think caution is sometimes required when a bootstrapping kind of thesis is presented, right? Because it's usually because you're trying to avoid the big capex number at the beginning, which is always has been, is now, and will be the greatest challenge for the single asset project developer, right? How do you efficiently fund all the upfront risk that your mine requires, right? So I think the approach we've taken is that, the best value in our deposit, whether it's, a smaller or a bigger deposit, and we think is getting substantially bigger, from a project point of view, is always going to be if that asset goes to one of the several other mills in the region, right? If you're not building the mill and you're not building a new tailings facility, on a project basis, you're always going to get the most value out of the project. So how do we ensure that maximum value project context means maximum value for Radisson shareholders, right, at a corporate level, right? So our job then is to know how big is our deposit going to be, what does it look like if you do send it to one of the several offsite mills, and so that we've done all the technical de-risking, metallurgy, and milling assessment of one of those mills, and put forward some credible numbers as to what that might look like on a snapshot basis. But it's always with a view to not presenting a kind of, oh, we're just going to get started mining here, we'll make some money, and then we'll go from there. It's what is the maximum value of that particular deposit in the ground, given the current state of affairs, which is we're surrounded by other people's mills and tailings facilities, and that's always going to give us the best bang for the buck, right? Going down that path. So, I think we're actually enjoying the realization that our deposit might be getting to the scale, and we have a pre-existing shaft in the old mine. We've got infrastructure there. We've got a size of deposit. It's going to trip over a line very quickly where building it as a standalone project actually might be the value, maximizing choice, right? But I would hope that given the amount of scar tissue I've got on my back in this business, that when we're presenting the standalone mine plan for O'Brien, it's going to be, okay, well, what's the best size to develop this project? Let's commit to it, and let's mine the high grade first and the low grade second, and rather than trying to kind of get going. And
it's important, you've got people like Pierre Baudin, right, on your board, your chair,
yeah,
and I've met
right.
Pierre, and I have a lot of respect for Pierre as a mine builder.
Peter McPhail as well, yeah.
At Peter McPhail, and like for us at Maple, we just brought on Mark Legault, right, who went from mine geology, actually started his career with Agnico. He was working at Eagle, at Joutel. So it's funny, as we pull the data from Joutel, similar to Radisson, we've got 2 existing shafts there. We've got high grade gold. We get zero value for Joutel today, despite the fact that we actually think it could be a potential second flagship for the company. And certainly from a mine planning standpoint, it's earlier days for Maple than it is for, say, Radisson or some of these other companies. But one of the interesting and unique aspects of where we are is because we have Agnico as our largest shareholder, right? So my approach in terms of what drives maximum value for Maple shareholders is, look, Agnico or any other mining company can optimize a mine plan better than any junior company. And they're going to do it, as Matt said, the right way, because they have the balance sheet to be able to do that. That doesn't mean that a junior company can ignore the development or the potential development path for those ounces at their peril, because all of those large companies and intermediate mid-tier companies, they're looking for not just number of ounces, but quality of ounces, right? So you have to show, for example, if you're looking at, and we had this discussion recently at a board meeting, we had people at site, and it's benefit of having people like Mark on the board. He said, well, how does Agnico look at, with the gold price doing what it's done, how do Agnico and the majors, what kind of prices do you think they're going to be using when they restate their, reserves and resources at the end of the year? I said, do you see that because of this rapid run-up in gold price, are these guys going to be using higher and higher gold prices to bring more ounces onto their balance sheet? And the answer to that is likely not, right? Because their shareholders are demanding, that they maintain those free cash flow margins, and so they want to take a conservative approach, right? So my earlier point about, if Agnico or majors can actually optimize mine plans better than us, doesn't mean that we ignore the optimization. Certainly Maple's involved with, Ausenco right now on trade-off studies, engineering studies that could helps us to answer the question when somebody asks us, what does a mine conceptually look like here, right? Instead of arm waving, like geologists are prone to do, I'm an engineer as well. So I want to be able to say, look, I think you've got a sequence here of going from an open pit, starter pit to underground, or doing them simultaneously. There's a central mill concept with, higher grade material coming from Douay, potentially blending ore from, Joutel, or putting it on a truck, sending it down to Sleeping Giant or Canadian Malartic or one of these other things. One of the things that I do know for us is because we have these 3 million ounces growing, we're in the midst of a resource update as well, which should be coming out, towards the end of the year, early next year. when you have this endowment of gold, the reason why Agnico's invested, I believe, in a company like Maple is because how undervalued our land package is relative to the fact you've got all this gold straddling a first order structure in the Abitibi. It necessitates good exploration, right? And so I think the interesting question to ask is like, is it exploration? Is it development? For me, I look at it and I say for Maple, it's both, right? Because I think we've got all the exploration, potential to really grow the deposit. And if we build critical mass, we've seen with this part of the world, it's not just one or two companies that are looking for an entry into a good jurisdiction with infrastructure. And I know we're going to touch on that in a bit. But, I think, again, as I said, I think the universe of companies with established ounces and, major scale projects in Canada and in jurisdictions where you don't have to spend a lot of money building the infrastructure, I think that's a very nice place to be, certainly for Maple and our shareholders.
Yeah, when I listen to both of you, and when we've spoken in the past, obviously Maple with Agnico Eagle, and Matt with Radisson, you're looking at milling arrangements with the likes of IM Gold, or building it yourself. But you're as we said right at the outset, you guys are in a district which is filled with infrastructure and processing capability. Do you sort of see a world where perhaps Abitibi companies start to kind of share that infrastructure and processing as a means to managing the economics and capturing the economics, or is it sort of the natural inclination to veer back to being fully in control of your own destiny? What do you think, Matt?
I've got a kind of a pipe dream that the Abitibi will someday have this big, enormous mill that is. Every mill in Quebec and Ontario have two things in common. They are owned by somebody, a corporate, and they are located beside an ore body that was discovered first, and then the mill was built beside the ore body. If we had a mill that was located on the basis of ease of access of infrastructure, and had a flow sheet which was flexible enough to take lots of different metallurgies and had the capacity to take multiple deposits, and which was commercially set up to do that. Somebody put the flag up that we are buying ore, right? There'd be a whole bunch of things would happen. There'd be a flurry of projects that would all of a sudden come to production, right? It is a bit of a pipe dream because all the mills are owned by companies, and it is a truism that owners of mills really want to have their own ore in the mill, right? They don't really want to have somebody else's ore in the mill. And so toll milling arrangements, whilst a lot of us, put our toes in that water, produce studies that sort of show that, what we're really doing is showing what the value of our project is going into somebody else's mill, right? Because there's always a mine manager saying, why are we, taking these guys, or, give me $10 million and I'll develop some, level 5 in the mine, and then that can come in, in 4 years' time. So that's usually the way it goes. And so what that means is that what usually happens in a well-functioning universe is the big company with mill buys small company with ore, right? That's usually how it goes out, right? And when and under what conditions that happens are the big unknowns, right? But usually, so if you ask a question about, are we going to enter into a universe where people are sharing infrastructure? Well, infrastructure is valuable, and these mills have a lot of value in them. A permitted tailings facility has a lot of value. They are jealously held, by the people who own them, right? And they don't want to close them, and so they need ore. And the heritage in the Abitibi is mills that have been there for decades, where successive ore bodies are found because of the endowment of the region, and then put through the mills. And almost all the mills most of the mills in Quebec, you can point to multiple ore bodies that have sequentially gone through that mill, right? So that is probably the way it will continue, I think, right? Again, it's a bit of a pipe dream to imagine that there would be this, almost like a public facility mill, right? Which was owned by a company whose business strategy is to buy ore, right? But that's probably not on the cards here. You hear fill the mill all the time. Agnico Eagle, and I, by the way, I'm a sort of cousin of the Agnico family. I had 2-year phase of my career where I was in their shop in Toronto, and I had all the Agnico guys. I was running a diamond subsidiary they had called Contact Diamond, and all the Agnico guys were cross-appointed down to my little sub. So I had a fantastic 2 years of seeing how the Agnico magic kind of works, and I had the highest regard for that company. And I was there when it went from a 1 mine to a 5 mine company. This was like 2005, 2006. So their success has been they've never bet the shop. They built a fantastically efficient business. They've got great company culture, and they're really committed to the right jurisdictions like Quebec. And so they are always in a fill the mill mindset, right? What's the next ore that's going to go to Martin? What's the next ore that's going to go to Iran? What's the next ore? And they're proud of their legacy. They're proud of the history of the company, the Joutel story, the Iran story. These are legacy assets for a company like Agnico, right? But fill the mill has always been the mindset, right? Because I like my mill and I want to keep my mill and I want to keep my mill working, and that's I think where companies like Radisson and companies like Maple are likely going to fit into.
Yeah, and I sorry, I was going to say, Matthew, one thing to build on what Matt said was, I think when, again, the long history that I've had with Agnico, and both on a transaction side, personal relationships there, but certainly since 2021, went back and certainly asked the leaders of Agnico, like, what was different about Maple, right? What was different? What made you want to not just, invest, because they're putting a lot of money to work in taking toehold equity investments in companies, but there's very few companies with whom they're forming 50-50 joint ventures, right? There was some rationale to doing that, right? And one of the rationales, I think it's fair to say, is, if you've got a 60,000 ton per day mill, and you're transitioning potentially in a few years, at 2020, 2021, I think they're obviously got a 40-year planning horizon, right? So they're saying, okay, well, we're going to be going underground at Odyssey, at Goldie. And so we're going to have capacity. And what kind of projects within a truckable, or railable distance of our mill has the potential to have the kind of scale to meet our threshold, right? And, the bar for success as the markets rise and lift all boats, certainly the quality companies are the ones that are going to outperform. And I think amongst the juniors, Maple and Radisson certainly stand out. But amongst the seniors, it's hard to argue that Agnico hasn't crushed its competition, right? And one of the reasons that they've done that is, again, it's the focus on low-cost, long-life operations with established infrastructure in a region that they understand and know very well. Now, what's interesting is we've seen with the juniors, the tendency, because I have that same dream as Matt, that, hey, like if you have and it's efficient even from a provincial, think about the benefits to the province, right? From a government perspective, from a tax base, we have all these undeveloped resources in province that are, they're very highly dependent on a constructive capital market in order for them to actually work. If you actually had that sort of central, consolidated infrastructure, certainly if it has to be owned by the right party, because, is somebody owning the right mill and then holding everybody, feet to the fire and making it uneconomic for them and more economic for somebody else is a transfer of wealth, as I think we would all agree. But I think one of the challenges, too, is we've seen a lot of companies come out with these development plans. It goes back to our earlier talking point on, what's the right size? What's the optimal size of a project? Well, you've got this 5,000 ton per day, below which you're sort of trying to go around the federal, EA process. So in theory, you can go to your market and say, okay, we've got a quicker path to production because we don't have to go with the 7 to 10 year sort of permitting timeline. And okay, that's great. But the problem is the infrastructure that gets built for those types of projects is going to be suboptimal, almost invariably, right? Because you have a bigger deposit that would benefit from economies of scale. You see, for example, like Agnico's mining at Detour is their biggest operation. And, they don't need massive grade there. They've got the tonnage, right? And they optimize. And so, I think that's to me is one of the things that now we're talking about different kinds of infrastructure. Mill infrastructure is different, and mill capacity and permitted tailings capacity, that's a tremendous advantage to have. But the road access, the power, the proximity to great labor forces and all those things, I think we all share that in this part of the world. I think the advantages, of course, are going to be where we can. Matt's done a great deal with IAMGOLD. We know that there are other mills that are in that region that are hungry. I think I'm on the board of a company in Ontario at Onyx where, you've seen a massive push by, Tony McCutch and Discovery and picking up old, projects. And there's going to be a revival, I believe, in this higher gold price environment of known regions with known gold endowments with established infrastructure. The question of how that's actually going to happen. I think some junior companies, will be on the bleeding edge. The ones that are just trying to just go it alone, not thinking about how all the puzzle pieces kind of fit together. Again, I think you ignore how you can work with all the endowment that we have. You ignore that at your peril.
Yeah. Well, one thing I would say, actually, Matt, is that, what Maple is doing with Agnico is always, in my experience, a good indicator for an investor, right? Because companies like Agnico, they're not there to keep the Maple share price down, right? They're not there to quash anything from happening. They're there because they like the asset. They've done technical work.
And the team. I think it's about teams as well, right?
They think it's about teams, and they think there's this future value there for all concerned, and I don't want to sort of speculate as to why Agnico is partnering with Maple, but for companies that take toeholds in companies, they're doing it because they're happy to pay more later on a bigger or de-risked asset that they have been involved in shepherding, right? Rather than and they're not stock pickers. They're there for the project. They're there for their business reasons. They're there with a technical kind of perspective, and it's easier for them to pay more for something that's bigger and lower risk than pay less for something which is earlier stage now, right? And so it's always a good sign, right? And an investor shouldn't be put off, and it's certainly not put off by that kind of situation. It's always a good validating statement.
Indeed. Validation done for you on. Well, I like that. Again, we speak to companies who have had that inflow of interest from big companies, and you make some great points there, Matt. They're not speculating on the stock price. That's not how they make money. This is about doing some diligence. If they like what they see, they think they may want a piece of it, they get involved. Well, look, gentlemen, I'm going to wrap it up there purely based on time, not because I've learned a lot in this session. So hopefully people listening or watching this will have learned a lot as well. But look, you're both in a really good place. You're in a good place financially, but obviously also physically, Quebec continues to rank as one of the best mining jurisdictions globally, and also certainly one of the most competitive. So folks, appreciate your time today. Anyone listening to this, got two superb examples of how CEOs can change the fortunes of companies right here. So Matt, thank you very much. Kiran, thank you.
Thank you.
Thanks,
See you
Matt.
next week, Kiran.
And thanks, Matt. See ya.
Yep.